let's focus on the space that's got the hardest knock this month. That's metal stocks. They have taken, a knock. They're down close to around 15% this month. For the year, they're down close to around 21%. And in spite of all this weakness, JP Morgan, they have an overweight rating on a couple of these stocks. Pinakin Parekh, Executive Director, Metals and Mining, Oil and Gas, as well as Cement at JP Morgan India, joins us on the show. Hi, Pinakin. You've been constant that you've been quite bullish on the metal space. And for some part of the last few months, from November lows, well, it worked out pretty well. We have been seeing weakness on these stocks. Do you believe that it's a good time to get into them? And if yes, what's your preference between ferrous and non-ferrous?
Yeah, good morning, Nigel. So essentially what has happened is that good news for the economy has been bad news for the markets. While the recent bounce in economic growth in US and Europe and improving data points in China are good for commodities per se, commodity equities have not reacted as positively. We continue to focus on the China reopening. Steel inventories declined for the first time last week in China. And this is particularly positive for the ferrous value chain as we enter the China 2 sessions and expect more positive news flow to come out and support the economy.
Okay, so more positive on ferrous versus non-ferrous. Preference for ferrous versus non-ferrous, right, Pinakin?
Break ho gaya hai. Yes, we would prefer ferrous over non-ferrous at this point of time, especially given the China rebound.
Pinakin, let's focus on pricing then here in India. Chinese prices have moved up dramatically, I think from around $510 to around $660 odd. So there's been a big increase. Indian prices have moved up, but not in the same manner. Do you believe there is a good chance that we see higher prices here in India? If yes, what is the price increases you're working with from year on? And also compare domestic prices with international imported prices.
Sure. So to start with, the domestic Indian steel prices never corrected as much as the Chinese HRC export prices did. What you had a situation in the second half of last year was that domestic Indian prices were at a premium to landed Chinese steel prices. So to that extent, the increase in domestic prices has been muted versus Chinese prices. That is simply the base. Domestic HRC prices are up roughly 11% from the lows of December. At this point of time, we estimate domestic HRC prices at around 60,000 rupees a ton. That will compare to landed steel prices from China at roughly 64,000 rupees a ton. So there is a good 5-7% gap over here, and we would expect domestic prices to increase. More important is to see what Chinese prices do, because at today's coking coal prices and iron ore prices, marginal mill in China on theoretical spot cost will be loss-making. So we would expect more price hikes to happen in China, which should eventually flow through to the Indian steel markets.
Pinakin, hi, good morning. Let's come to the non-ferrous now. Hindalco, let's start there. I mean, on Friday it sold off, right? Big time, some 5% cut on Friday. Again, I mean, what's your thought process on Hindalco and the non-ferrous side?
So again, apologies, Prashant, we will not be able to speak on company-specific names. On non-ferrous, again, overall, the macro in China, if it continues to open up, it will be positive for non-ferrous as well, base metals as well. Inventories are low. Having said this, base metal prices tend to be more influenced by global investor flows versus non-ferrous versus ferrous commodity prices. So to that extent, any weakness in equity markets tend to flow through the base metal commodity prices. We have seen aluminum, zinc, copper prices sell off, even though on the ground inventories have been depleting. There have been production cuts in Yunnan in China because of drought. So you have a divergence between the fundamentals of the commodity and the prices of the commodity, more driven by investor fund flows, and that will influence stocks in the sector as well.
You do track the entire oil and gas space as well, CGD, downstream OMCs, ONGC. With Brent around these levels at $84 a barrel, what do you think the scenario would be for